Hello, my name is David Johnson from QuotedData, and I'm sitting down with Nick Brind of Polar Capital. Nick, could you give us a quick introduction for yourself and the strategy that you run?
I'm Nick Brind. I'm one of the co-fund managers of the Polar Capital Global Financials Investment Trust. It's a listed investment trust and it gives investors a broad exposure to financials globally. It has an income and growth mandate. It was launched back in 2013 and has been going for 11 years now.
So Nick, could you give us sort of like an elevator pitch for Polar Capital Financial, sort of how you look about investing, sort of what a portfolio looks like, what you're thinking of when you're buying companies?
You're getting shares in some great, fantastic companies. JP Morgan, MasterCard, Visa, American Express, Berkshire Hathaway. These businesses have delivered fantastic returns to shareholders, and we think they will continue to do so. And the sector is made up of three core sectors: banks, insurers, and diversified financials. So banks can be split up into investment banks. They could be retail banks. Insurers might be doing motor insurance. They might be doing commercial insurance, or they could be doing reinsurance. Diversified financials is much more diversified. So you've had asset managers, stock exchanges, consumer finance companies, asset managers. So you've got an incredibly diversified sector which can give you different opportunities globally. We have a quality bias to the way we go about picking stocks. We like companies with strong balance sheets. If it's a bank, then you've got to have good liquidity, a good funding franchise. We like businesses that have strong moats or competitive niches which they operate in, and then around that we factor in where we're trying to find the best value.
What advantages would a portfolio sort of actively managed financials bring to a typical investor?
It's seen as a value sector. So when we say that, stocks on average trade at lower price earnings multiples or price to book multiples. But because it's so diversified, you've got a mix of companies that trade on much higher multiples and others that trade on much lower multiples, reflecting the way the market perceives their opportunity.
So it's great that financials trade in just cheap multiples, but what does that, I guess, mean for an investor, so to say? Does it make it a safer bet to invest in? Is it more defensive? Does it blend better? Because so many people, they tend to have that sort of technology bias inherently.
So there's two things to bring out from that. One is that cheapness sometimes reflects it's more cyclical, so it's more economically sensitive. So in a environment where you're seeing the outlook for growth or interest rates improve, you'd expect the sector to outperform, and vice versa, all things being equal. And therefore it is perceived as a riskier sector. Having said that, within it there's a lot of businesses, companies that are much less economically sensitive, much more defensive. When we're constructing the portfolio, we're always conscious of balancing the risks from both ends of the spectrum to bring together a portfolio that gives a balanced risk-reward.
That's really interesting. Financials have been actually sort of almost a sleeper hit. Certainly within America, you talk about the large banks, etc. They've been the dominant force. They've been the largest sector outperformers. Is there any commentary you could give to that?
Yeah, the outperformance has been broad-based, both from banks, insurers, and diversified financials. Now, within that, there's always a degree of dispersion. You've seen some of the alternative asset managers, things like Blackstone and KKR. They've done brilliantly. You've seen some really significant share price rises. And there's always laggards around that, where there's some disappointments. And US has led that performance. More recently, there's been a big jump post the election of Donald Trump and obviously incoming Republican administration. But it's certainly an area that's quietly surprised.
Given that it's been a great year for financials in general, how's your trust, how's PCFT done over 2024?
It's been a good year. We were 2.5% ahead of the wider market a few months ago. We're now 1% behind, so we're still up 29%. That's a great result. We'd prefer to be ahead. But that quality bias, we think, within the portfolio has meant that that's held us back a little bit.
It's interesting that you say that sort of quality held you back. I mean, what's the inherent advantages, I guess, for quality? I mean, has it been the long-term driver for performance?
Over the very long run, we believe, and I think it's backed up by academic evidence, that quality businesses do outperform. They give you a better risk-adjusted return. So during periods when the markets are extremely strong, yes, we're going to lag that. But it's, from an outcomes perspective, where this year has been a great year for people invested in the equity market.
Thinking about your trust over 2024, what are you most sort of grateful for, and what have been your best sort of decisions and stock picks over the year?
Things that perform well in the portfolio, stocks like JP Morgan and Barclays. So in an environment where expectations for a soft landing, so there's no recession to happen, then there's expectation for more activity in financial markets, more M&A activity. So the investment banking businesses of the likes of JP Morgan and Barclays have done better, and you've seen positive earnings revisions on the back of that.
Being overly aggressive, I don't think that's probably the worst issue one can have, certainly. Is there anything else that was a bit challenging over 2024?
The factor that probably also surprised us is the momentum in some of the more highly valued stocks that just continued past where we thought is a reasonable valuation. There's been maybe a technical squeeze on some of the large banks that have done incredibly well. Good banks, but we think they're overvalued.
What do you see for the next year? Sort of what are the things you're excited about? What are the major factors or events that are on your radar?
When markets have done so well over the last couple of years, you'd expect to see lower returns in 2025. And in that sense, the attraction of financials is being the biggest constituent of value indices because of the low valuations. If we see any rotation out of growth stocks into value stocks for whatever reason, then financials will be big beneficiaries of that. The other point I think I'd make is ultimately, if we do have a more benign outlook for global growth, for the US economy, then that's good for financials. They're a play on the soft landing. They are cyclical businesses.
The valuations point is really interesting because from what I understand is that the gulf in valuations between financials and almost everything else, and especially in the US, things like technology, is enormous. I just don't think people kind of realize how big that gulf is and how different the sensitivity it means for these different sectors. I wonder if you could just make a comment on that in the context of what you've just described.
When you're buying businesses on a lower valuation, it gives you downside protection from market events, or even maybe some underlying deterioration in the individual business. And that's a nice risk reward. When markets are expensive as they are today, then you need continued positive surprises to generate good returns from buying certain stocks. Sometimes people say, financials a value trap. Well, financials have returned about 9.5% per annum on average for the last 10 or 11 years. If you go from 2020, it's more like 18% per annum. So that's a great value trap. The flip side of that is you could say we're in a great growth bubble. And the risks of that ever deflating, think about diversification when you're looking at how you're positioned with your investments and not putting all your eggs in that one growth basket.
It's interesting that you mentioned sort of all your eggs in one basket and a benign market going into next year. What do you feel that will mean for investors who use sort of passive investing ETFs? I mean, that's been the big thing, and of course you yourself are an active manager. Do you have a view on that?
Passive investing ETFs, it's a great tool for investors, to get cheap access to equity markets or other asset classes. And there'll be times when passive is the best place to have your money. Equally, active will have its day in the sun again. And I think the best way to think about the future is what's happened in the past. And the last 10 plus years, you've had the Eurozone crisis, you've had Brexit, you've had a pandemic, you've had a war in Europe. And yet over that period, you've actually seen really good returns be generated from investing in global financials. And if you look forward over the next 3, 5, 10 years, no reason why that can't continue. And that's probably the rationale and opportunity for investing in the sector.